Welcome to the 40 Finance channel, everybody. Today we're talking about mortgage rates, and most notably, if you're an existing homeowner and you've been in your same home for, let's just say, 4 or 5 years, do you feel trapped by your current mortgage interest rate? This is something that I think is really starting to come to a head across the country, particularly if the needs of your family or perhaps your work are changing and there's more pressure on you to move for whatever reason, and you're walking away, like this person did here on this Reddit thread. You're walking away from a sub 3% mortgage. And at least as of today, you're likely walking into a mortgage rate of 7% or so on your next purchase. So, this is an interesting fork in the road for, I think, a lot of Americans. It applies to me from the number standpoint, but in my current home, I don't have any additional needs. Our needs are not changing. So I'm able to preserve the existing interest rate. But that world for some folks like me could be changing in the near future as well. Now, before we get into all the math behind this, I did want to call out what was my favorite quote, many people's favorite quote in this thread. And this was a supportive comment. And you see here at the bottom, life is more than a spreadsheet, so good for you. And there's dozens and dozens of supporters in here who are in the exact same situation. Now, when this scenario boils down to schools and space within the home, all those things, I think life does get incrementally better, even though the costs go up. Probably the hardest situation that I can imagine is when employment changes. Hopefully, of course, in that situation, you're being compensated to make up for what will likely be a big difference in your mortgage payments. Now, I've lived in my house for over 15 years, and there's really no reason for us to move right now, which is great. But just for illustration purposes, I thought I'd put on the board the situation that we'd be looking at if we needed to move right now. So back in the day, we bought our house for about $250,000. I didn't get into down payments and all that on this. It's a 3% interest rate across 30 years. And looking past taxes and insurance and all that, that would be a monthly payment of about $1,000. All right, so next I dreamed up a situation where, what if we had to move? What are some rough numbers on what it would be? Well, a lot of the houses in my area have basically doubled since 15 years ago. So if we were going to try to match all the things that we have today that we would like, we're probably looking at a situation like that. And let's just say for fun that we wanted to get something bigger this time, right? So instead of a $250,000 house, it would just be $700,000, which is really not that uncommon these days. And I'll pretend that we put $200,000 down from the equity that we had in the first one. So a 30-year loan for $500,000 at a 7% APR. In this, scenario, you're talking about a mortgage rate that triples, or a mortgage payment that triples outside of taxes and insurance. And depending on where you live, if it's anything like Ohio where I live, your property taxes are based on a percentage of your home's value. So even if you just moved right down the street into a more expensive home, you would absolutely for sure pay more in property taxes because your home would be more valuable. So just in that fake scenario alone, I'd probably be looking at 3x what I currently pay for my mortgage. Now, if you want to do apples to apples and see the difference, if it was $250,000, 3% versus 7%, the difference would be about $600 a month. But again, the big thing is 15 years ago, you could find a $250,000 house. There's not too many of those out there, at least here in Cincinnati. Now, if you follow the stock market, economy type topics in general, you know that the big problem nowadays is housing inventory. This is an active listing count over time for just Ohio. Okay, So you look back into 2017, I'll start down here. 2017, you had about 33,000 listings in February of 2017. And this past 2024, you have 12,000 listings. And with that, you obviously had in 2024 about a third of the homes to look at. So the limited listings have obviously helped home appreciation values over time. But what's interesting, I mean, if you really got back to like COVID and interest rates and all those things, that inventory really hasn't changed much since it took such a huge drop off in 2020. Now, it does look like there's been a tick up here. November of 24, you were just under 20,000 active listings. If we go back to 2017 that I was just looking at, they had 34,000 listings versus basically this past November, you had 20. So the gap seems to be getting a little bit smaller, but it's a ways to go still till I would say you have a true open market for real estate where people are actually comparing multiple homes that they may want to buy instead of just thinking about one. And anytime you have more products to choose from or more listings to choose from, that's going to help with pricing. To this day, in my area, there's still not a lot of banter back and forth on the price of a home, let alone some of the elements that I'm familiar with, which, home inspections, adjustments to the contract when you find certain things in home inspections. None of that really exists right now. And that's probably the next best case scenario that we would even get back to that point. Right now, if you get an inspection on a home, it's just for your own due diligence. The seller doesn't really care what you find. That's what the price of the home is, take it or leave it. Now, the silent killer in all this, as it pertains to the economy, in my opinion, is this huge lot of equity that America has in their homes that is almost untappable because of their current mortgage interest rate. So this is just a 5-year chart going back to pre-COVID in 2019. You had an equity level of $19 billion in America. And here we are on Q2 of 2024 was the last time that they reported on it. And it's now $35 billion. So if you follow the economics of consumer buying over the past several years, there was a world where home equity was a much more like open door process. People would use it all the time. If you go back to interest rates, even in this period, let's just say 2015 through 2019, interest rates were very, very steady. And even when they got hot, so to speak, in November of 2018, prior to COVID, it was still below 5%. And in a world like this, you have sort of a natural adjustment to home equity rates because people could have things that happened in their life. They could be facing financial trouble, medical bills, whatever it is. And the home equity lines were there as sort of a safety net. But now with interest rates so much higher than the actual mortgage rate that you have, there's much less of an incentive to tap into that. And I think over time, that really starts to hurt the larger purchases in America. By larger purchases, you start to think about things like cars, boats, renovations, things of that nature. And it obviously also stalls out the amount of money that could be on the open market into buying homes. So bottom line here, this particular thread on Reddit talking about, people nervous about leaving their low interest rate, I think it encompasses quite a few things that could go wrong as we continue in the US economy. Number one, we already know that housing is generally unaffordable, and the selection of homes is a third of what people got to experience less than 10 years ago. The other thing that's much different than what we've seen 10 years ago and beyond is the equity level that most homeowners have that is all but trapped under these new interest rates. So instead of a revolving door or perhaps people moving up to the next tier of purchases in their life, all this invisible money is locked up because of interest rates. And then lastly, if you've watched as interest rates have come down very slowly from the Fed this year, there's a lot of question marks of how long the lowering can actually go because we're still not seeing monumental progress in terms of the economic indicators that influence that. So from where I sit, I see a lot of problems that are locked up in residential housing right now that could actually help the economy hit the next wave of growth. But at least on my radar, I don't see a big solve for it anytime soon. All right, guys, let me know. Are you locked into a wonderfully low mortgage interest rate? And has that affected any of your recent life choices in terms of moving, jobs, houses, all the things that we talked about here today? I have a feeling that this problem will continue to be a problem for the next few years. As always, thanks for watching. Hope everybody's doing well. We'll see you on the next video.